On today's hot sheet, I'm discussing the just released Consumer Price Index report, as well as our May rental report and weekly mortgage applications. Today is Wednesday, June 12th, 2024. I am Byron Lazine, and the hot sheet starts now. Welcome into the hot sheet. Let me know in the live chat which market you're tuning in from today. And it is CPI day. It's a huge day because we get CPI, Consumer Price Index, which was just released at 8:30 a.m. Eastern time this morning. I'm going to go through that in detail, what it means for the markets. But we also, this afternoon, will have Jerome Powell and his press conference coming out of the FOMC meeting, which started yesterday. It's wrapping up today. The FOMC's putting together their projections of where inflation is headed and what decision they made today or are making right now as we speak about where to move the federal target rate. Now, the expectations are that he's going to come on this afternoon and say that these things are unchanged. Today's CPI report does not factor in unless they had it leaked to them early, which is also with our government more than likely. Okay, so maybe they put some of this into consideration, but I think overall they probably aren't. But when we get the Jerome Powell press conference later today, we'll be breaking it down here at BAM as we do every single Wednesday afternoon, about 45 days apart when the FOMC has their meetings. We're going to break it all down, and tomorrow I'll go line by line through that transcript with you on everything in housing, okay? But first, let's go after the CPI for May. The headline is, all items are unchanged for May. That met expectations. So for those hot inflation reports that we got in January and February and March, now we've got a couple of months where we're starting to meet expectations again. So we look back at quarter one. Was quarter one just more of high prices to start the year, prices going up to start the year, businesses adjusting? Certainly could be. And now we're starting to come back to getting into a place where we're progressing with inflation. Or, as some say, and I heard some say this on CNBC this morning, we're just kind of stuck. We're in this bumpy road, this sticky road. We're not, it's unchanged, but it's not really, it met expectations, but it's not really moving in a deep enough direction to say that we are beating inflation. Now, some of the numbers in here, as you dig a little bit deeper into this Consumer Price Index report, again for May 2024, some of the numbers in here are pretty good. One of the numbers in particular was as good as, and that number would be all items, 3.3%. This is as good as we've seen in a number of years, going back to 2020. Okay, if we just look here, what does unchanged mean? The 1 month percent change in CPI for all urban consumers. Unchanged means that last month to this month we've had no change. Okay, from April to May. There you can see that's the lowest of the last year. That's the best mark of the last year when you go month over month on inflation. I mentioned back in February, January, and February and March, we were heading up. And now that trend line is heading down. Okay. We were on our way down last year. We really had some nice momentum. And then we started the year and started to head back up. You can see that blue line going back up. Not the case now. Now we have 2 months of starting to really get somewhere here with inflation. But it was all despite shelter. That's going to be the messaging out there. Housing didn't help. For all the gains that we saw otherwise in the economy, it wasn't because of housing. In fact, housing remains at 0.4% for the fourth consecutive month. Shelter. They label it as shelter. So we had a great decline in gas, but the index for shelter more than made up and offset for it. all other indications were pretty good. The housing market keeps holding us back. I don't expect Jerome Powell to say, gee, I'd really, when he comes up there today, gee, I'd really like to see that 30-year fix come down. Remember, the Fed doesn't care if people buy homes. In fact, they would prefer that they don't. The Fed cares about getting inflation down to 0.2% or to 2% rather, and maximizing employment. You're not going to hear anything about Jerome Powell on that. He takes his mandates from politicians who want to keep spending money on their missions, not the American people's missions necessarily at home. You don't hear many politicians. Every once in a while, you get a couple. We've gone through it in the past that'll talk about, man, it should be more affordable for people to buy homes. Otherwise, you hear politicians spending your tax dollars in a variety of other ways. A lot of times overseas, in other countries. Whole nother topic for another day. But you don't hear a lot of people talking about how do we get more people into home ownership? And the environment right now of where we're at in the fight against inflation, I don't see anybody at the Fed, Jerome or anybody from the panel, from the board, saying, hey, we want to get that 30-year fix lower. So when I hear the conversations on CNBC this morning that we're stuck in this right now, we're just kind of stuck where we're at, essentially going sideways, I tend to agree with that. I tend to agree with the projections that have the housing market sitting at 4 million sales over the next 2-3 years, which is 1978 levels. Okay. I tend to agree that we're going to see higher interest rates for longer because anything lower, we know, than that pent up background demand. We'll get into current demand right now. That pent up backup demand will shoot those prices right back up. People want to buy homes. These restrictive policies have just made it very difficult to do so. If we look at shelter, it makes up 36+% of the weight of CPI. It's over a third. Owner's equivalent rent of residences is over 26, almost 27% of it. Owner's equivalent rent for the last 4 months has been up 0.4%. Same thing with shelter overall, 0.4% for the last 4 months. Shelter year over year is 5.4. Owner's equivalent rent of residences is 5.7. So when you have that much weight in those two categories, of course, it's going to keep inflation higher. It is the thing right now that is keeping inflation higher. The all items is 3.3% annually adjusted before seasonal adjustment, rather. 3.3 versus 5.4 and 5.7. You take owner's equivalent rent out, which I'm an advocate of. Wall Street Journal wrote about this. It's a made up number. You're surveying people who aren't even in the game as opposed to using real-time data. We're going to get to some real-time data, though, in a minute that might not support shelter coming down. I'll get to that in just a second. But if you take owner's equivalent rent out and you look at this like some areas in Europe do, we would already be close to the 2%, if not there today. That'd be a case for potentially getting to cutting the rates. Now, there's a lot of people that you can't cut the rates. We've borrowed far too much money. Going back to our politicians, they love to spend. All of that borrowing we've done, our interest payments in this country are higher than that of our defense budget and really other important ways that we spend money. Our interest payments are higher. So you can't get this rate down too low when our interest payments are as high as they are. It's one of those cases for the rate staying higher for longer. We just keep spending out of control, borrowing out of control as a country. And with that, when you had a number of years, almost a decade at interest rates near 0%, recovering from the great financial crisis, you're going to have to pay that at some point. Recovering from the COVID crisis, you're going to have to pay that price at some point. It's why when a buyer asks you as a real estate agent, well, when do you think these rates are going to come down? I don't know. When do you think the next financial crisis, or when do you think the next pandemic is going to come around? Are you anticipating it happening after November? It certainly could. It's a possibility. That could be the next crisis. A good crisis can bring lower interest rates. When you look at all the recessions, what typically happens in them? The 30-year fix comes down. So as real estate professionals, if you're waiting for the 30-year fix to come down, you're also kind of saying, I'm waiting for some type of crisis. Maybe in this case, it would be the commercial lending crisis, commercial office building crisis. That kind of fits the narrative. A lot of that money's coming due the end of this year and into next year. Refinances are going to be hard for commercial building owners. Maybe that's the next crisis. Maybe it's something else. But for the 30-year fix to come down, we're probably looking at something that is not a great economy, not great news for all. So I'd say get used to it. If we want the economy to keep moving and growing, you're going to be dealing with rates higher for longer. We're going to be dealing with this basement level of home sales. Okay. And I don't think we want that, but that's we want to keep more people employed. We want to keep as good of an economy as we can. Or maybe you're in the camp, hey, rip the Band-Aid off. We've borrowed too much money. We need a reset. Okay. Either way, for the agents that think 2021 is a market that's natural normal coming back, just look at the last 20, 25 years of home sales, total home sales. 21 was a peak. And then it was less, of course, than, 05 and 06. But those are like the top 3 or 4 in the last 20, 25 years. Those aren't normal. Okay, yeah, we want to get back to 5 million existing home sales in this country, get closer to normal. We want to, doesn't mean we will in the next 2 or 3 years. I get it. Things are hard for real estate professionals right now. You got a couple of black swan events. You've got a real estate recession that we're dealing with on top of new industry changes. It's why those that continue to stay in it and work through it and create opportunities for those in their community now will be highly rewarded come 2 or 3 years when things do shift. We'll have a bigger brand through all of that. We'll have more opportunities and clients for life through all of that. Laura says there are humans who actually think 2020 are there humans who actually think 2021 is coming back. I would hope not. I think there are some agents, though, that are lusting for easier times. Okay. Great agents are going to be made in these harder times. And I just don't want to confuse. I think there was a lot of confusion in January with people saying, hey, there's going to be 5% rates this year. Things are going to get better, easier at some point. No, just focus in on what we've got. Okay, we've got a CPI. We're going to see what Powell says later today. If you're in real estate, you're in one of the most restrictive rate industries there is. We are impacted by the rates as much as or more than any other industry. So it's important what Jerome Powell says later today. It's important to highlight to a home buyer or an investor who doesn't necessarily get that, doesn't necessarily understand how the markets work, to show them, hey, in the last 25 years when rates really got low, it was in recovery mode to major crises, a long drawn out one after the great financial crisis and a short, immediate steroid jab to the arm recovery after the COVID one. Okay, those were the two times when we had to drop rates, which dropped the 10-year, dropped the 30-year, and stimulate in a big way. If you're looking for the 30-year fixed rate to drop significantly into the sub 4 or 4 range, which is when people say, I want the rates to drop, a lot of times that's what they're thinking. You're waiting for huge stimulus to come. There's no indications that that would come. That would skyrocket inflation. We've seen that. We've told that story. So helping them understand that, that's step one. Step two is helping them understand what could you afford in a normalized interest rate market like we're living through right now at 7%. What are the opportunities for you? Now, maybe prices will come down. You know, I saw a report from, I think, Bobby, you sent me that one, and we can get into this one at some point here. I haven't dug into it yet because I think, would you send me that at midnight last night, Bobby? At 9 p.m. 9 p.m. Eastern last night, which feels like midnight for me. But the Redfin CEO says on Business Insider, maybe, Bobby, I don't know if you can have it. You can show the headline. Home prices will go down this summer as sellers can't postpone listing any longer. Okay. The more rates stay up, and if Redfin CEO is right, I mean, he's like a baseball player. He hits about 300. He's right about 30% of the time, stuff that I hear him say. So, you know, like a baseball player, he could go 1 for 3. He could be right on this. If he's Business Insider has a terrible paywall. Yeah, all right. So go ahead, show the headline. If the Redfin CEO is right, and there are home sellers that are they've been waiting for this rate to go down because they're typically buyers on the other end. But if he's right that they just can't wait any longer, eventually they'll go on the market. And what we're seeing right now with demand, going to talk about demand here in a second. We get an update on mortgage applications. What we're seeing with demand, what we're seeing with inventory increases. If he's right and more people go on the market, then just simple supply and demand economics will hold true. And those that are serious about selling, that need to sell, will have to lower the price. Okay, we talk about, if I've got a home seller and they're like, I want to sell right now, I got to sell. Okay, do we want to focus on yesterday's record prices, or do we want to focus on this weekend's demand? So if we want to sell this weekend's demand and competition plays a significant role in how we price. I get it. The last 2 years, you've seen nothing but record prices in your community. We might want to target a price below our aspirations, where the market is this weekend, with demand, total showings that we're seeing online, and our current competition, which is up and higher than what we saw a year ago. Why are we seeing homes sit longer on the market? We're seeing homes sit longer on the market because, well, I did a CMA, and this is the best price. It was the best price for yesterday. CMA is rear view mirror. This weekend is windshield. It's what's in front of us. It's what's going to happen Saturday and Sunday in a summertime environment, in a time when people have other things to keep them interested. There are other things happening on this June weekend, right? We've got the U.S. Open, the men's open for golf. We've got Father's Day. We've got a lot of other distractions happening this weekend. Probably some high school graduations happening this weekend. All of that's going on. It's all a distraction from my home search, my home journey. It's going to pull people away for sure. So if you're pricing for this weekend, it's a different consideration than April of this year, certainly than April of 2023, where some of these records were set, or at least some of the early records were set. Okay. All right. So CPI comes in. unchanged in May, up from 3.3% from a year ago. Both numbers were 1 percentage point below market expectations. So what have we seen with that? We saw the futures jump up. Right now, just coming into today, off of this unchanged, you got the Dow up, you got the S&P up, you got the NASDAQ up. Okay, so market responding to that. Remember that we saw everything kind of go down at the end of on Friday of last week when you saw that hot jobs report. Kind of basically just erased that here today. We'll see what happens. Anything we could shift again this afternoon when Powell speaks. We'll see what he comes out with. And again, right in the CNBC, it's being driven by shelter primarily. Here's a pretty good chart to show you, though. We want to take our wins when we've got them. How good May is, 0%. We haven't seen that since, unchanged since July of 22. But unchanged means that July was also 1.2% like the prior month. Okay, so not good there. You definitely don't want to see those kind of numbers being unchanged. This is a good win for us in the fight against inflation. A very small win doesn't mean that the Fed should cut rates. They certainly won't cut rates. Housing related numbers have been a sticking point in the Federal Reserve's inflation battle and make up a heavy share of CPI weighting. That's what CNBC is reporting. Robert Frick, corporate economist with Navy Federal Credit Union, says finally some positive surprises, both headline and core inflation beat forecasts. But it also says until those shelter costs begin their long-awaited fall, we don't see major drops in CPI. We need major drops to get to where we want to go. But unfortunately, if we look forward, we've got a report here from Realtor.com that doesn't suggest that we should expect those shelter numbers to drop anytime soon. May 2024 rental report, slower decline in rent suggests inflation may continue. Okay, this is coming from Realtor.com analytics. May 2024 marks the 10 year-over-year rent decline. I read that and I say that's what I would expect with all the inventory coming out into the rental market. And that is, to me, a good thing. Although asking rate rents only dipped by $13 or 0.7% year over year. Okay. Median asking rent in 50 largest metros was registering in at $1,732, up from $10 last month, but still $24 from its August 2022 peak. So went up there a little bit. Median rent declined in all size categories with larger declines in smaller size units. So kind of, I guess, a little bit sideways, declined again, but it's also the peak is just 1.4%, or rent is just 1.4% below June 22 peak. We're kind of flattening out here. 10 months decline year over year. To me, Realtor.com's headline, it's like, I don't know, this kind of suggests we're going in the right direction. We're going to get more inventory later in the year and into next year on rental units from the multifamily sector. That, to me, should create more competition, lowering prices. Of course, the argument is less people are buying, so more people are going to have to go ahead and rent. So what's that going to do to those rent prices overall? All rent units saw declines, studio, 1 bedroom, and 2 bedroom. That's good news. All the charts are available for you inside of BAMX. So if you're a BAMX member, grab those there. If you're not a BAMX member, you're missing out on a new course every single month. You're missing out on the hot sheet show notes every single day, the hot sheet charts every single day, which we put available for you, and the community. And of course, 25% off of BAM Mania happening October 18th. BAMX in a box on Friday, content done for you every single Friday, where we give you templates pulling from the hot sheet content, email scripts, video scripts, blogs, social graphics, all done for you every single Friday. BAMX in a box. You got to be a BAMX member to get that. You get so much in BAMX. The value is over the top. These numbers to me aren't over the top on rental. Year-over-year growth in median asking rents is up a little bit, but not. Or no, median asking rents are down just a little bit. Okay, while CPI shelter index is stickier, it is expected to decline for the rest of the year. So Realtor.com expects this number to go down. Finally, some of this data catching up. Okay. So that to me is good news. Slower decline in rents suggests inflation may continue as their headline, but then they go on to say that this CPI shelter is expected to decline for the rest of the year. We've been flat, as I showed you before, at 0.4% on shelter. So that would be a good thing. Okay. Here's the share of renters who moved in the last 12 months. That number is going down. That's in line with the charts that we looked at in the hot sheet here recently, where people are staying in those rents for longer. Okay. Looking at the 50 largest metropolitan areas, I'll highlight some of these ones here. Atlanta year over year is down 5.8%. Austin down 9.3%. Austin, you've got a lot of inventory. So these areas where you got a lot of inventory coming in, you can see more declines. Charlotte down 5%. You've got Dallas down 3.7%. Indianapolis, though, up 4.4%. Miami down 4.4%. Nashville's down 8.3%. Lot of multifamily building there. Orlando's down 6.4%. San Antonio's down 8.2%. So the areas where you've seen more multifamily building, they're going down the most. What also continues to go down more than any of us would want is mortgage application data. Okay. The purchase data has been going down week over week over week, but not last week. Last week, mortgage applications went up 15.6% from 1 week earlier. It's a huge win. We're in a season where they usually go down. But as you saw, that little bit of shift of the rates going from almost the mid sevens down to 7 boosted mortgage applications, 15.6% on the total. That was really driven by refis, increasing 28% from the previous week. The refinance market increasing 28% from the previous week by rates going from basically 7.5 to 7. That's an indication to me that this economy is not working for everybody. People need to refi for getting cash for whatever particular reason that they might have. A 28% jump in a week off a half a point move from 7.5 to 7. It also tells me that the comments from the Redfin CEO that some people aren't going to be able to hold out forever, that's a data point right there that suggests that might be true. If they're caving on moving out of either owning the house outright, who refinances? Okay, I don't have a mortgage on the house, and I'm going to refinance the home. Or I have a rate right now, which is likely lower than where I'm at. It'd be hard to believe somebody's now just waking up being like, oh, I have a 12% interest rate. Let me refi now. And they didn't do it in the last few years. Okay, so they're probably financing some of that equity out, and they're increasing the interest rate. 28% jump in 1 week going from 7.5 to 7. The seasonally adjusted purchase index, this is the number that we care about the most, increased 9% from a week earlier, although it is 12% lower than the same week 1 year ago. We have less demand than we did a year ago. Let's be real here, okay? But we did get a week over week increase, okay? And hopefully we're going to get back down to that 7% level today, as long as Powell doesn't screw it up this afternoon, which is a total possibility. I get it. Yesterday we came in at 7.16. So we've been hanging around that 7.15 since Friday with the jobs report. But today We kind of erased that jobs report on the 10-year. Look at the 10-year today off of the CPI data coming in. It dropped sharply down. We're back down to 2.75. This is a case for getting to about 7%, which is where we saw the drive in the mortgage application data last week. That's good. We'll take everything that we can get. These are small numbers. They're coming off of low numbers. Okay. The mortgage application data is so low. We got to go back to 1995 to see levels similar to today. Okay. Yes, we had more mortgage application demand in 2009, in 10, in 11, in 12, in 13, in 14, and 15 than we do today. You have to go back to 1995 to see mortgage application data this low. So we increased 28% in the past week. We increased 9% on the purchase index, but we're coming off of levels. You got to go back to 95 to realize. So when someone says to you about the demand for their house is, here's the reality. There are less people applying for a mortgage today than we've seen at any time since 1995. Doesn't mean that you can't get a near record price on your home, meaning we're at all-time high. Doesn't mean you can't get within 5% of that number. It just means we need to be strategic about how we go out and make sure we're taking everything into consideration. I really think these conversations with sellers are important because the demand is not what it was just a couple of years ago. And neither is the refinance. So even when you see that refinance number drop off, you got to go back to 2001, 2000 to see refinances at this level. Okay. 2019, they got pretty low as well. Okay. Obviously 2020 to 21, they shot up. Still, those weren't to the levels of when we were just giving money away in during, the great financial crisis days there. Okay. All right, there you go. There's your data on today. We're going to get Jerome Powell later today. Maybe we can get Jerome Powell to speak at BAM Mania. I don't know. He does so well in these press conferences. We're going to break down his press conference tomorrow. If you want to join us, not Jerome, at Circa Las Vegas on October 18th, hit the link below. Grab your ticket for BAM Mania. Early bird pricing is almost over. Those tickets are selling. If you're a BAMX member, remember you get 25% off of early bird pricing. So BAMX members, utilize that. You have a personal code to do so, BAMX members. If you don't know what your code is, email me, byron@nowbam.com. I'll get you connected to that. And I hope to see a bunch of you guys there in Vegas. I will see all of you back here on the hot sheet tomorrow, 9:30 on the East, 6:30 on the West, to break down everything Jerome Powell says about our housing market. Until then, of course, toodaloo.